we are in a new era where in the past it was growth at all costs.
Mhm.
Uh, Now it's certainly not the case. Certainly from the customer side, customers are sharpening the pencil. Sales cycles are elongating. They're pushing back on vendors. How should companies think about the difference between growth and profitability in an environment like this? And how do they think about it, reacting to the environment? Because on one hand, you don't want to whipsaw the company and being reactionary, but on the other side, you don't want to be tone deaf to environment changes. So that conundrum of growth versus, not burning as much, or profitability if you're much later stage or public. What's your experience and best practice around that?
Yeah, I mean, I think, the world has changed, right? It's pretty remarkable what we've seen in the last couple of years. It went from, as you said, sort of growth almost at any cost, right? To now it's sort of, balancing, right, growth and profit. And you're certainly seeing that in the public markets. So I think that, trying to dial that in against the backdrop of what's the burn rate, what's the runway? I mean, a lot of companies I work with, it's like we're trying to plan for, several years worth of runway, a path to profitability, demonstrable, breadcrumbs, success to get to, those sort of target levels, quarter by quarter. But to your point, the environment's shifting rapidly. And, as an example, Q1, right? I mean, we went from the financial vertical, being in full buying mode to, quite a bit of headwinds with the SVB collapse and all of the other, issues in terms of the markets. And so, having some sort of back to like that downside model and having a sense of what the levers are to be able to pull back. What are the gates, right, to make those decisions? Are there certain thresholds, certain burn rates? How do you make those tough decisions? Because it is a very dynamic environment. But what I am seeing is a lot of companies really shift gears and look at sort of that rule of 40 framework, right? We want to be able to balance growth and profitability and try to show some progress against that, and at least a path to get to the point where we're not the burn rate isn't so high, because I don't think people can depend on the access to capital like the way they could call it a year ago, nor liquidity events like IPOs on the near term horizon.
And there's a few questions in the chat. I know we're going to take questions at the end, but since it's connected to thinking about growth versus profitability for under 10 million ARR companies, and maybe I'll touch on it since we've spent a lot of time there. I think it comes back to exactly what you said, Kimberly, which is, you have to think about your runway, right? It's not growth at all costs. And, as a sub 10 million ARR company, do you have enough runway to hit key milestones, of which revenue is one of the things that you're looking at. But for a lot of sub 10 million ARR companies, it's not just revenue. There are other key milestones in terms of the quality of revenue, the type of revenue, the type of logos, the level of repeatability that you're trying to show. Do you have a more lumpy or a less lumpy business, for example? And so runway and levers, exactly as you said, actually come back to the sub 10 million world. I think probably less applicable in the sub 10 million world is rule of 40. But it's one of those things that, I think one of your mantras that you had mentioned is, as early as possible, start thinking about what it means to be a public company, forecastability, predictability, ultimately getting to a rule of 40, thinking about, can you get into a beat and raise mindset? What does it take to do that? The more quote unquote practice you get before, you're a public company, I think was your point that the better shape you'll be in once you become a public company. And so I think that's where those lessons can be applied to the earlier stage businesses.